Shining gold. Digital money. Which asset will increase your family's wealth and enable you to achieve your most extravagant financial goals? Precious metal bars have served as prudent investors' safe haven against inflation and financial foolishness for generations. Through wars, depressions, and the rise and fall of empires, gold remained constant. But today, the mysterious Bitcoin competes with gold as a new form of store of value. This computer-generated invention has appreciated more quickly than gold has in the past. Which asset deserves your trust and investment? Can Bitcoin's rise continue, or will gold retake its rightful place as the original form of money? Gold was created by nature's molten forge over eons as actual, palpable money. Only existing online, software engineers have influence over Bitcoin's future. For monarchs and peasants alike over thousands of years, gold maintained its purchasing power. A decade into its unsure future, Bitcoin is an experiment run on internet connections. The worth of gold is acknowledged and appreciated everywhere. Many people still don't understand Bitcoin, several countries have banned it, and it could face legal action. Bitcoin, however, also provides a constant supply unaffected by discovery or depletion, which is something gold cannot. Transportability over distances in a matter of minutes rather than weeks. The likelihood of price escalation that is exponential as adoption increases. Bitcoin shares some important characteristics with gold, including durability, divisibility, uniformity, and scarcity. However, Bitcoin improves these qualities for a digital age. Investor attention is shifting to assets that have a track record of protecting wealth as national currencies tumble and inflation soars. But gilded gold or virtual currency, which will shine brighter in the digital age? Consider the following extra benefits and drawbacks when choosing between investing in gold and Bitcoin. Gold's benefits. Physically possessed tangible asset. A lengthy history of serving as a store of value. Low supply and high mining output. Valued as precious by all people. Diversification of a portfolio is provided. Disadvantages of gold. Does not generate profits or dividends. Exposure to security threats including theft. The price of storage and insurance. Price rigging by powerful holders. Lack of liquidity in relation to financial assets. Bitcoin benefits. Digital and transferable internationally. Possibility of high rewards as adoption increases. Inflation-resistant transparent ledger. Fixed supply with verifiable scarcity. Physical storage costs are not incurred. Bitcoin drawbacks. Unpredictable pricing results from extreme volatility. No indisputable support or inherent value. Regulatory ambiguity persists. Exponential to cybersecurity errors. A very new and developing asset class. The fundamental distinction between Bitcoin and gold is between their physical properties and cultural histories. While Bitcoin has a greater upward potential but higher risk, gold gives more stability. Combining the two can help balance a portfolio. Here are some instances where gold and Bitcoin have performed differently historically as investments. Why from $35 per ounce in 1971 to over $1,800 in the last 50 years, gold has increased by nearly 4,000%. In comparison to Bitcoin's gains, gold's growth appears modest. Since its inception in 2009, the price of one Bitcoin has increased by more than 194,000%, from about 10 cents to its current price of over $19,000. Why Bitcoin increased by nearly 9,900% between January 2013 and the market peak in December 2017, whilst gold only had a 7% increase during the same time period. This demonstrates the quick and dramatic upward movement of Bitcoin. Despite this, Bitcoin has twice in the past 10 years had sharp collapses of over 80% during bad markets, whereas gold is often more stable. Why as investors flock to safe haven assets during financial crises like the pandemic of 2020, Bitcoin and gold both experienced significant price increases. Bitcoin rose by almost 300% while gold increased by 25%. While Bitcoin may have higher long-term gains, it also has more pronounced boom and bust cycles and corrections. Gold historically provides strong, consistent returns. Having a portion of each asset could help a portfolio stay balanced. A 50-50 allocation offers greater Bitcoin growth potential, while a 90-10 split supports stability with a bigger exposure to gold. Therefore, the evidence demonstrates that Bitcoin experiences heart-wrenching volatility along with fantastic profits during periods of expanding popularity. Over an extended period, gold appreciates consistently and serves as an insurance policy. Combining the two could improve overall investment performance and even it out. Yes, there are dangers to take into account while buying gold and Bitcoin. Risks of investing in gold. The price of gold may change due to variables such as interest rates, inflation, the strength of the dollar, and geopolitical unrest. No assurances that purchasing power will remain. Security hazards associated with physical storage and movement of gold include theft and loss. The price of purchasing secure storage or insurance. There are no dividends or cash flows, simply the opportunity for capital growth. Lack of liquidity, difficult to buy/sell in big amounts rapidly compared to other financial assets like stocks or bonds. If selling for a profit, capital gains taxes might be due, lowering overall return. Investment risks with Bitcoin. Bitcoin's value is highly volatile on a daily basis, making prices uncertain. There is still regulatory ambiguity, and government restrictions might affect its viability. Vulnerable to breaches in cybersecurity, hacking, fraud, and forgotten passwords that might destroy possessions. Less stability is offered in the absence of financial backing or guarantees from the government. Reliance on adoption. The value of Bitcoin hinges on its widespread adoption, which might not happen. Why Bitcoin might become obsolete due to competition from more advanced cryptocurrencies. The tax treatment is still not clear, susceptible to shifting legal requirements, and difficult to sell. Although each asset has its own advantages, intelligent investors are aware of the risks. To mitigate these investing risks, it's imperative to allocate assets appropriately, take security measures, and maintain current knowledge. Here are some tips for building a mixed portfolio of gold and Bitcoin investments. Make allocations based on your level of risk tolerance. More conservative investors would choose an 80-20 or 70-30 gold to Bitcoin ratio, whilst more risk-tolerant investors might choose 50-50 or 60-40 allocations. Use Bitcoin as a growth engine by allocating a smaller portion of your portfolio to it, 10 to 20%, to increase returns while maintaining the majority of your money in safe investments like gold. Periodically rebalance. As the price of gold and Bitcoin fluctuates, periodically rebalance your allocations to preserve desired ratios. Bitcoin minimum viable allocation. If you want to expose your portfolio to Bitcoin as an emerging asset class, think about allocating at least 5% of your portfolio to it. Maintain core gold position. To preserve capital, maintain a 50 to 60% allocation to gold, with the remainder going to Bitcoin or other alternative assets. Invest in a variety of gold products, including bullion, exchange-traded funds, ETFs, mining equities, etc., and keep Bitcoin in cold storage and invest in crypto stocks. Use dollar cost averaging to spread out your investments over time rather than making them all at once. The ideal distribution will vary depending on your unique investing objectives. Periodically check the ratios to rebalance. The benefits of both Bitcoin and gold may be maximized with the right diversification and allocation. Compared to other assets, Bitcoin has the potential for very high investment returns due to a few important factors. Scarcity. Since there is a fixed amount of 21 million Bitcoins, there is a built-in scarcity as demand increases. Prices are raised as a result of this supply restriction. Increased use. As more people and organizations use Bitcoin for transactions, investments, or value storage, there may be a sharp rise in price. Network effects. As the network expands, Bitcoin's value increases, creating incentives for continued user adoption. Self-reinforcing demand results from this. Insight. The open blockchain used by Bitcoin offers complete insight into the dynamics of supply and demand, lowering the uncertainty that encourages greater valuations. Regulatory legitimacy. If Bitcoin is recognized by the government as more legitimate, institutional capital worth billions might enter the market and drive up prices. Widespread acceptance. If Bitcoin gains widespread acceptance, much like the internet did in the 1990s, expect speculative mania to set in and lead to a sharp price increase. Set unit supply. Unlike fiat currencies, which have a flexible supply, Bitcoin has a set unit supply of 21 million coins, ensuring that current coins appreciate in value over time. Even while previous performance doesn't guarantee future outcomes, Bitcoin has shown that it can generate returns of over 100,000% in less than 10 years amid significant adoption booms. If widespread mainstream adoption continues, there is still a tremendous upside potential. The following advice will help you reduce security concerns while buying gold or Bitcoin. To get gold, purchase gold only from reputable sellers, and always have it examined. Store items in an insured vault or licensed depository rather than keeping a lot of them at home. If keeping at home, spend money on a reliable safe that is bolted down and fireproof. Install cameras and a security system if you plan to store a lot of stuff there. Only keep little quantities on you or in your possession that you can afford to lose. Use a valuable asset insurance policy from a reliable provider to insure your gold against theft or loss. Using Bitcoin. Safeguard the private keys by using a hardware wallet like the Trezor or Ledger. Distribute your Bitcoin over many wallets, and for larger holdings, use multi-signature agreements. Transfer the majority of your assets to cold storage and only keep a tiny portion in web-based hot wallets for active use. Turn on two-factor authentication for all used exchange and wallet services. Maintain software updates and create strong, one-of-a-kind passwords for each account. To reduce risks, familiarize yourself with the various cyber-attack techniques. Security vigilance and storage diversification are essential for preventing theft of investments in both gold and Bitcoin. The wisest decision in tumultuous times might be to hold both treasures. Therefore, place your bets and divide your cryptocurrency and gold coins. The ultimate investment will be determined by history.